Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 9th of September. I'm Daniel Lam, your host for the podcast. Once again, gold had been making headlines recently. After going sideways for the better part of this year, it broke above the key resistance at 3,500. Now, the recent run over the last 2 weeks was due to a number of factors, including continued uncertainties around tariff, growing US debt concerns, questions over Fed independence, and of course, expectations of monetary easing. The demand for gold has moved from official sector flows to macro drivers because there has been rising correlation with real yields, as well as with the VIX index, which represents market volatility. Now, the volatility in gold last Friday, when the non-farm payroll figure came out, shows its safe haven appeal. As the macro data softens, we can see investors more focused on the diversification and safe haven benefits of gold. The possibility of a 50 basis point cut at the September Fed meeting, instead of a 25 basis point cut that has already been priced into risky assets, is fueling further near-term upside. I want to highlight two standout areas in gold buying. First of all, gold exchange-traded products buying accelerated at its fastest pace since February over the last 2 weeks. Moreover, there has been increase in volume traded across many regional exchanges, especially at the Shanghai Gold Exchange. Therefore, we would advocate buying gold on pullback, especially if it gets back to the key support level around 3,360. But in 2025, silver has been stealing the show. Silver rose over 40% and broke above the US dollar 40 level for the first time since 2011. Now, technically, this has become a new support level, and we see further gains to extend to $42. Now, silver is often seen as a high beta version of gold. It shares similar macro factors as gold. For example, Fed rate cuts and a weak US dollar would be supportive for silver. Supply deficits and tight inventories have also been sending silver higher. But do watch out, as it is more sensitive to industrial demand versus gold, so slowdown in this area of demand could lead to volatility. And this explains why silver did not perform as well as gold since the latest non-farm payroll, because the job numbers were weak, prompting concerns about slowing growth and industrial activities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.